Now, today's topic is Group Statement of Cash Flow. IS 7 Statement of Cash Flow provide guidance on the preparation of a statement of cash flow. The objective of the statement of cash flow is to provide information to an entity's change in cash and cash equivalent during the period. The statement of financial position and statement of profit and loss are prepared on accrual basis and do not show how the business has generated and used the cash in the reporting period. The statement of a profit and loss may show profits even though company is suffering severe cash flow problem. A statement of cash flow is therefore important because it enables users of financial statement to assess liquidity, solvency and financial adaptability of the business. Now, the conceptual framework. According to the conceptual framework, investors, lenders, and other creditors can only make informed decisions if provided with information that helps them to predict an entity's future cash flow. Historical cash flow information, as presented in statement of cash flow, will help these users to assess the amount, likelihood, and certainty of entity's future cash flow. Analysis of cash outflow may also help user to assess management stewardship of entities' assets. The performer for the statement of cash flow is as follows. The statement of cash flow is divided into three parts: cash flow from operating activities, cash flows from financing activities, cash flows from financing activities, investing activities and operating activities. Now beginning with the statement of cash flow, the first section will be cash flows from operating activities. Cash flow from operating activity will comprise of profit before tax. We will add finance costs less the investment income because it's part of statement of investment, part of investing activity, less income from associate, it is also the part of investing activity. Adjust for non-cash item dealt with within the arriving at the operating profit, like add back the depreciation less gain on subsidiary. So add back the depreciation less the gain on disposal of subsidiary, add loss on the disposal of subsidiary or any asset, add loss on the impairment charge to P&L, add the loss on disposal of non-current asset, add increase in provision. Now changes in working capital. Increase in inventory will be deducted, increase in receivable will be deducted, or decrease in the payable will be deducted. In case of the reverse, decrease in the inventory will be added back, decrease in the receivable will be added back, and increase in payable will be added back. Now the net amount after all this will be cash generated or used from operation. Now interest going to be deducted, tax paid will going to be deducted. The net amount will be net cash flow, inflow or outflow from operating activities. The next title will be cash flow from investing activity. It will comprise of payment to purchase non-current asset will be deducted minus receipt from non-current asset disposal plus net cash paid to acquire subsidiary minus net cash proceed from subsidiary disposal will be plus cash paid to acquire associate minus dividend received from associate plus interest received plus. The net amount of all these figures will be a net cash inflow or outflow from investing activity. The next heading will be cash flow from financing activity. Proceed from share issue plus proceed from loan or debenture issue plus cash repayment of loan or debenture minus lease liability repayment minus equity dividend paid by parent minus dividend paid to non-controlling interest minus. The net amount will be net cash inflow or outflow from financing activity, and the net amount of all these figures will be either an increase or decrease in the cash and cash equivalent. Now there will be a term that will be cash and cash equivalent brought forward from the previous year. This will be either be added or deducted, and there will be a cash and cash equivalent carried forward. Now moving to the next topic, that is classification of cash flows. IS 7 does not prescribe a specific format for the statement of cash flow, although it requires that cash flows are classified under one of the three headings. First heading, cash flow from operating activities, defined as entities' principal revenue earning activities and other activities that do not fall under the next two headings. Means entities' principal revenue earning activities. The second is cash flow from investing activities, defined as acquisition and disposal of long-term assets and other investment, excluding cash equivalent. Acquisition and disposal of long-term assets and other investment. And third is cash flow from financing activity, defined as activities that change the size and composition of entities' equity and borrowing. Now going in depth, cash flow from operating activities. The key figure within the cash flow statement from operating activity is cash generated from operation. There are two methods of calculating cash generated for operation: direct method and indirect method. The direct method shows operating cash receipts and payments, such as cash receipts from customer, cash payment to supplier, and cash payment to and on behalf of employees. Other method is indirect method. This method starts with the profit before tax and adjusts for non-cash charges and credit, deferrals and accruals of past or future operating cash receipts and payment, as well as for items that relate to investing and financing activity. The most frequently occurring adjustment required are finance cost and investment income, depreciation or amortization charge for the year, impairment charge to profit or loss in the year, profit and loss on the disposal of non-current assets, change in inventories, change in trade receivable, change in trade payables. IS 7 permits either method, although encourage the use of direct method. A comparison between the direct and indirect method to arrive at cash generated for operation is there, and it will be a difference. Now, what is the investor's perspective? Entity can choose whether to present cash generated from operation using direct method or indirect method. There is a problem for the users of financial statement because it limits comparability. The majority of the company use the indirect method for the preparation of statement of cash flow. They justify this on the ground that the information required for the direct method is too costly and time consuming to obtain. The adjustments required by the indirect method are difficult to understand and can be confusing to financial statement user. In many cases, these adjustments cannot be reconciled to observe changes in the statement of financial position. The financial statement user often prepare the direct method because reports operating cash flow in understandable categories such as cash collected from customers, cash paid to supplier, cash paid to employees, and cash paid for other operating expenses. When presented in this way, user can assess the majority trends in cash flow and can compare these to the entity's competitors. This is relevant information because it aids investment decision. Cash flow from investing activities. Cash flow to appear under this heading include cash paid for property, plant and equipment and other non-current assets, cash received on the sale of property, plant and equipment, other non-current assets, cash paid for investment in or loan or to other entity, excluding movement on the loans from financial institution which are shown under financing, cash received for the sale of investment for or the repayment of loan to other entity, again excluding loan from financial institution. Now, cash flow from financing activities. Financing cash flows mainly comprise receipt or payment of principal from from or to external provider of finance. Financing cash inflows include receipt from issuing shares or other equity instrument. Second, receipt from issuing debentures, loan notes, bonds, and other form of long and short-term borrowing other than overdraft, which are normally included in cash and cash equivalent. IAS 7 say the financing cash outflow include repayment of amount borrowed other than overdraft, the capital element of lease payments, and payment to reacquire or redeem entity share. Interest and dividends. IAS 7 allow interest and dividend, whether received or paid, to be classified under any of the three headings, provided the classification is consistent from period to period. The practice adopted is in this text is to classify interest received as a cash flow from investing activities, interest paid as a cash flow from operating activities, dividend received as a cash flow from investing activity, dividend paid as a cash flow from financing activity. What is the term cash and cash equivalent? The statement of cash flow reconciles cash and cash equivalent at the start of the reporting to the end of the reporting. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amount of cash and are subject to insignificant risk of change in value. IAS 7 does not define readily convertible but notes that investment would qualify as a cash equivalent if had a short maturity of 3 months or less from the date of acquisition. Equity investment are generally excluded from being included in the cash equivalents because there is a significant risk of change in value. IAS 7 makes an exception for preference shares with a short period to maturity and specified redemption date. Now, preparation of consolidated statement of cash flow. A consolidated statement of cash flow shows the cash flows between a group and third parties. It is prepared using the consolidated statement of financial position and consolidated statement of profit or loss. This means that intra-group transactions have already been eliminated. When producing a consolidated statement of cash flow, there are three extra elements that need to be considered: acquisition and disposal of subsidiary, cash paid to non-controlling interest, and third, associate. Now, acquisition and disposal of subsidiary. Acquisition first. In the statement of cash flow, we must record the actual cash flow for the purchase of subsidiary, net of any cash held by the subsidiary that is now controlled by the group. Means purchase consideration less the cash of the subsidiary, any cash the subsidiary have. The assets and liabilities of the acquired subsidiary must be included in any of the working to calculate the cash movement for an item during the year. Now, disposal. The statement of cash flow will show the cash received from the sale of the subsidiary, net of any cash held by the subsidiary that the group has lost control over it. Means cash received less the cash of subsidiary that left the group. The assets and liabilities of the disposed subsidiary must be included in any of the working to calculate the cash movement for the item during the year. Cash paid to non-controlling interest. When a subsidiary that is not wholly owned pays a dividend, some of the dividend is paid outside of the group to the non-controlling interest. Dividend paid to non-controlling interest should be disclosed separately in statement of cash flow. To calculate the dividend paid, reconcile the non-controlling interest in the statement of financial position from the opening and closing balance. You can use a T account or schedule to do this. Associates. An associate is a company over which an investor has significant influence. The associates are not part of the group, and therefore cash flows between the group and associate must be reported in statement of cash flow. Cash flows relating to the associate that need to be separately reported within the statement of cash flow are as follow: dividend received from associate, loans made to the associates, cash payment to acquire associate, cash received from the sale of associate. These cash flows should be presented as cash flows from investing activities. They are part of investing activity. Remember, associates are accounted using equity method. This means that the consolidated statement of profit and loss, the group records its share of associate profit for the year. This is a non-cash income, so must be deducted in the reconciliation between profit before tax and cash generated from operations. Foreign exchange and cash flow statement. Exchange gain and losses in individual books of parent and subsidiary. The value of assets and liability denominated in an overseas currency will increase or decrease partly due to movement in exchange rate. These movement must be factored into your working in order to determine the actual cash payment and receipt during the year. Now here is a brief explanation. For example, if an exchange loss increases the carrying amount, for example, on a liability, there is an exchange loss, then this increases the carrying amount of liability. This is not a cash flow. Therefore, exchange loss must be factored into the cash flow working as follows, like balance brought forward. Now we will add the exchange loss in the brought forward balance, and there will be a balance carried forward, and the balancing figure will be the cash receipt. Here the exchange loss is added in because it is a liability. Now overseas cash balances. If cash balances are partly dominated in foreign currency, the effect of exchange rate movement must be reported in statement of cash flow in order to reconcile the cash balances at the beginning and end of the period. According to IAS 7, the reconciling item is presented separately from cash flows from operating, investing and financing activities. There are some issues in the IAS 7 statement of cash flow. There are some criticisms that are made on the IAS 7 statement of cash flow. First, that is direct and indirect method, allowing entities to choose between using direct or indirect method of presenting cash generated from operation limits comparability. Many users of the financial statement will not understand adjustment made to the profit when the cash generated from operation is presented using indirect method. Secondly, the lack of guidance and disagreement. This is insufficient guidance in IAS 7 as how to classify cash flow. This can create the following problem. IAS 7 allowed dividend and interest paid to be presented as a cash flow from either the operating or financing activity. This limits the comparability between the companies. It allows the dividend and interest paid to be either classified as operating and financing activities. Secondly, the entity may classify cash flow related to same transaction in different ways, like a loan repayment might be split between interest paid within the operating activity and repayment of principal amount in financing activity. This could hinder user understanding. Next, there is disagreement about the presentation of payment related to lease. They argue that they should be classified as financing activity, whereas others argue they form part of investment activity. So there is an argument on classification of lease, that it should be financing. Some say it should be an investment activity. And the last, expenditure on research is classified as an operating activity. Some argue that should be included in investing activity because it relates to the items that are intended to generate future income and cash flow. And lastly, disclosures. Current cash flow disclosure are deemed to be inadequate. In particular, there is a lack of disclosure about the restriction on an entity's ability to use its cash and cash equivalent, particularly if located overseas, and whether other sources of finance would be more economical. So this marks the end of this group statement of cash flow. To summarize the entire cash flow on the group, I'm going to do a quick summary, that is objective. This is a chapter summary. Objective of statement of cash flow is to provide information on changes in cash and cash equivalent and enable the users to understand, assess the liquidity, solvency and financial adaptability of the business. Classification of cash flow is in 3 headings: operating, financing and investing activities. Preparation of group statement of cash flow, 3 additional items have to be considered, that is cash paid to non-controlling as interest, associate, acquisition, disposal of subsidiary and associate. When there is a foreign currency transaction, exchange gains must be taken out of the statement of financial position movement as they are not cash. And evaluation of statement of cash flow, they provide information not available in statement of balance sheet and the statement of profit and loss. And secondly, it shows the relationship between the profitability and cash generating ability. So this is the end of this foreign currency. This is the end of group statement of cash flow.